Here we turn to China and to some key pieces when we look at what's happening in Asia. Now, when we look at China, I think some of the key components that we want to identify is what is happening on the export-import side, what is happening with PPI, CPI, a lot of these key pieces, and then we'll have additional data because this doesn't have the most recent retail sales and everything else because there's been additional data that has come out that is increasing the pain that we're seeing on just the economic front. But we will talk through it. We will talk about what those estimates were and what they ended up coming in at because it's important to appreciate, where are they now and where are they going in general. So when we look at foreign reserves, you can see that there was a slight tick up, the expectation to 3.1 trillion, which it came from the export side. But as we've talked about before, and again, this isn't because we have a vendetta against China or anything else. It's just the way we look at things when you're talking about supply chains. Imports are indicative of local consumption and future exports. And here you can see that imports year over year were expected to be up 4%, came in at 2.3%. And yes, exports went up. There was still backlog. You still had areas reopening. That's, again, the imports is just showing, and then the retail sales confirmed. And just to give you what retail sales were, expectation was for them to be year-to-date to be up 0.1%. Instead, they were at negative 0.2%. So again, retail sales are contracting, and this is before you even adjust for inflation. So that's why imports are under that pressure. We continue to see those problems in general. PPI was expected to be at 4.9%, came in at 4.2%. CPI expected to be at 2.9%, came in at 2.7%, but CPI is still above last month. So you're starting to see some of this creep up in general, but the bigger issue that we continue to see is aggregate financing, expected to be at 1.3 billion, came in at 756 billion, 1.3 trillion, came in at 756 billion. New yuan loans were expected to be at 1.1 trillion, came in at 679 billion. So more pressure ahead, more pressure coming. And again, that's slowing down, that will slow down, I should say, the money supply because the PBOC continues to see this struggle. We've talked about it, not last week, but the week before, just about how much pressure there is on the loan side, how there just isn't that demand, especially on the private sector. Now, before we get into retail sales and the other key pieces, Christmas is going to be a problem because on Thursday, the eastern city of EU in Zhejiang province was put under a 3-day COVID lockdown. EU boasts merely 1.9 million residents, modest by PRC standards, but it's home to the world's largest small commodities market and is therefore a major Chinese export base. They manufacture around 2/3 of the world's Christmas products. So I think that's, again, you're just seeing more issues that are going to come about. Now, this, as they reopen, you'll have backlog that'll support exports. But where are imports in general? So all individuals are confined to their residential compounds and some can't leave their apartments. All factory production has been suspended except manufacturing of medical products and daily necessities. Logistic companies can only continue operations in closed loop bubbles. Transportation in or out of the city is banned. 4 COVID-19 infections were reported. By Thursday, case numbers had climbed to 500. The initial lockdown could be extended for a prolonged period. If the outbreak isn't contained, a prolonged lockdown in EU could seriously hurt China's exports in the second half and add another headwind to China's economy because the exports have been kind of the saving grace over the last couple of months, just as you had that catch up in terms of where those flows are. Now, when we pivot over to the real GDP growth, the industrial output value added, and retail sales, you get an idea of where the pressure is. So July economic data is very alarming. Authorities need to deliver a full-fledged support from property to COVID policy in order to arrest further economic decline. Retail sales rose 2.7% year on year in July, down from a 3.1% increase in June. And as we were saying, missed estimates by a wide margin. Fixed asset investment rose 3.5% in July compared with 5.8% and fixed investment was supposed to be at 6.2%. So, I mean, you're talking about a significant miss to the downside in terms of what actually came about. Then value add output at industrial firms rose 3.8% in July versus a 3.9% increase. And then the value add in industrial production came in slightly in line, was expected to be at 4.3, came in at 3.8. So again, you're starting to see a lot of those things. And again, a lot of the impacts are expected to be dire. The data missed expectations across the board. Analysts had a forecast of 4.6% increase in industrial value add. Year to date, FAI or the fixed assets ex rural growth of 5.7% missed expectations. But at the heart of it, the weak numbers were the twin problems of China's real estate slowdown and zero COVID policy. Households still show no signs of adjusting their wallets. The imports are supporting that. Retail sales are supporting that. Everything that we're seeing is just pointing to, obviously, problems, but at the same time, you have unemployment at the 16 to 24-year-old level at almost 20%. I think it's 19.9. We have the number later. That's a record. So again, you have a record amount of unemployment at the younger side, elevated unemployment elsewhere, with lockdowns, with problems, keeping a lot of this locked. The real estate sector also took another turn for the worse. Investment fell by 12.1% compared with 9.6% in June, so getting worse. Home sales worsened from a 23% year-on-year drop to 28.6%. Weaker real estate activity dragged down the industrial sector. Floor space under construction plummeted 45.2% in July. Production of steel and cement were down 6.4% and 7% year over year. In the face of the stimulus measures, or simply, again, not cutting it. Infrastructure rose slightly in July, but not anywhere near, with CapEx at SOEs, again, increased because they continue to drive and rely on state-owned entities to try to turn this, and we don't see any of this adjusting. So, again, there's just the survey jobless rate fell to 5.4% versus 5.5%, while the youth unemployment rate hit a record of 20%, which is again continuing to be those overhangs that we see in terms of just how quickly they can get themselves out of this. Now, when we start looking at bank lending, China's banks in general, when we look at the underlying flows, I don't know why there we go. China's bank property loans dropped first time in 10 years. So the government, the PBOC, has told banks that they have to lend to property sectors, but the growth in new loans is now negative in 2Q. It should bounce in Q3 because they got very firm with what those numbers had to be, but it gives you an idea of just where it's coming from. China bank lending to the real estate sector dropped for the first time in 10 years, and the decline could persist, which we think is likely. The economy only grew at 2.5% in the first 6 months of 2022. Remember, their target was 5.5%, which is what they would have to try to make up in the next, now that we're in August, in the next several months. And as we're going through August, the data is just getting worse, not better, which is why when you look at what, I think Goldman took their expectations from 3.3% to 3%, it's going to be very difficult to make that up given the underlying backdrop and how bad things have been so far through Q3. Recent GDP data, whether Q1, Q2, or the first half, looks terrible. Most key growth drivers, the property sector, private investment, consumption, are all failing to fire under strain from regulatory movements. The writing's on the wall, obviously, in terms of where we see things going. The GDP target now for the year has obviously been thrown out. But what does it mean for next year? How much of the makeup are we going to see in general? Because they want to keep it within a reasonable range, especially given how important the coming Congress is happening into October into November. So the government keeps trying to push massive infrastructure stimulus package, but as we showed last year, half of the special purpose bonds were not utilized. They didn't go anywhere, creating a big problem. And there are plans to try to add the stimulus, but as you look down that fiscal barrel, There's really nothing big that's coming through, but despite the size of the second half stimulus, there are significant barriers that will hamper its effectiveness. And again, it's just nobody is looking for that debt, which is the problem, because everybody's already so leveraged. So just making more debt available is not going to incentivize anybody to do it because they don't have the capacity for that stimulus. Now, when we start looking at the underlying backdrop, they keep trying to talk about build stuff, and we don't see that happening. Well, again, they're trying to drum up that stimulus. And in the insights, we're going to talk more about what that stimulus is and why we see additional failures. Now, when we look at those retail sales versus online sales, things have slowed in general from the online front. Auto sales did pick up, but auto dealers' business sentiment, again, that consumer confidence and consumer spending, that consumer confidence remaining at record lows. And as you can see, going back through 2017, the lowest it's ever been, gives you an idea of where that spending is going and how the trend is really going to continue to be negative. And there's really been no recovery in China without a revival in real estate. It's no surprise because as we talked about in segment 3, the U.S., if you look at real estate matches that business profile, which is why we see that excessive decline in that recession. Well, the same thing is happening here. And the problem is even more so. So typically, when you look at U.S. backdrops, so the U.S. Wealth, about 27% of it is attached to real estate. In China, depending on the metric you use, it's anywhere between 67% and 70%. So there is very little that can be done without a turnaround in the real estate sector, but you have a lot of those headwinds coming through in terms of where things are going, where some of those benefits are going to be, and the problems that we continue to see in the system. So again, infrastructure spending has never turned the cycle around by itself because infrastructure spending and construction have always gone hand in hand with real estate. And right now, we're just not getting that real estate turn. But at the same time, as we've talked about it for several years now, the population turn is moving in the wrong direction. The population is getting worse. And that, again, is another metric that is going to create a lot of these different areas. China's economy lost momentum in July, and its construction, property, retail sales, which are moving further down. Exports remaining elevated, but some of that is the catch up, and now we will start to see some of those pressures as we talked about with the import front. Chinese total social financing impulses, excluding local government bonds. And I think that's the important piece, because when you exclude local governments, because right now they're telling the SOEs they have to take bonds, they have to take this. But when you take that out, you're negative. We are not seeing the type of industrial viewpoint that we should see. And again, this is why we keep saying there is that failure of the credit impulse. We're just not seeing it. Because when you include local government bonds, it's still coming down, but it's at least positive. And that's all driven by the SOEs as the private entities, the small entities, the consumer does not want debt. And that's where we continue to see those headwinds. China industrial production year over year. And it's important to look at the trend. You know, the trend continues to come down. You had 2019 where you were trending down. You had some spikes up. But as we talked about in 2019, especially the second half of 19, we saw a lot of problems coming through. And that has only carried throughout. And as that industrial production has rolled over, you've seen employment be actually in contraction. So Chinese retail sales that bounced, but even though typically, and you can see it with 2020, you had a bounce and then you had a big recovery after those lockdowns. We're just not getting that because there's uncertainty. Well, am I going to have a job? What am I going to have going forward? What is my income going to be? What is my savings going to be? Am I going to have another lockdown that I have to prepare for? People are just not in a comfortable state. Youth unemployment crisis. So even though we did get a little bit of a downtick in another, you have just in general, Youth unemployment hitting a record. So July survey-based jobless rate for 16 to 24-year-olds at 19.9%, highest on record. Jobless rates for those aged, and then up from 19.3% in June. And this is where we continue to see that spending, that concern about what is coming next. Where are people going to get these jobs? And that's one of the reasons why the BRI, or the Belt and Road Initiative, was created to give them jobs and send them somewhere else. The shock July data, and just to give you an idea, the China new home prices were expected to be at negative 10% and 10 basis points. Instead, it came in at negative 11 basis points. China new home prices down in July, negative 1.7%. So again, you're catching it on all fronts. There's nothing here to really drive us higher, especially when you start looking at loans. So remember, they've been trying to pump this debt into the system. So Chinese monthly new loans, you can see it's the lowest it's been since 2016, and China aggregate financing is the lowest it's been in the last 5 years. And this is with SOEs taking more capital. They're taking more of this, and there's nothing there for the private sector. The demand is not there. It hasn't been there all the way through, and it remains the case here. There will be a bump. You can see it's typically seasonal, but we're just not getting the same type of adoption because the projects don't exist in the way they have in the past. China new loan, this is looking at the aggregate now. So again, you're falling back down. And this is with that pull forward of SPBs. That's the pull forward of debt. You're just not getting that aggregate build with aggregate financing cumulative coming back below that 2020 rate. So now when we start looking at, again, the credit impulses 6-month lead, manufacturing PMI, all moving in the wrong direction, total social financing at that 1.7%, non-banking loans, but then the total, that slight back. So credit impulses remained in negative territory despite a sequential rebound of total loans quarter over quarter. But as you look forward, again, you're getting those pullbacks. And when you take out the SPBs of the local governments, you're actually already in contraction. Surprise reduction. So the PBOC is trying to reduce rates. But if you look at this, since 2019, you look at the rates, there's been no, and again, we can go back through to 2009, there's been very limited periods of tightening. So the impact is not as broadly felt because the law of diminishing returns means you need a much bigger increase, you need a much bigger adoption in order to get the same type of impact. And again, this is where the PBOC is limited in its actions it can take, because as you cut rates, yes, maybe making the interest rates a bit cheaper will incentivize some of these different products, but right now we're just not seeing it. We're just not getting the same type of demand because most of these companies are saturated with debt. Faster consumer inflation. So China's CPI accelerated to the highest since July of 2020. Consumer inflation reaches a 2-year high as pork surged. The pickup in CPI was lower than the expectations, but compares with 2.5% in the previous. The consumer price, the producer price, but remember, pork prices jumped 20.2% last month, with the government springing into action to bring down pork prices. This is the pace of growth is unlikely to persist. But again, it's like a whack-a-mole. When you look at the PBOC, they every time they hit another problem, 2 crop up. So then they hit 2 problems, 4 crop up. And that's why they're going to be able to keep inflation from rising or the rate of change, but they're not going to be able to push it back down because every time they create a tailwind, more headwinds pop up. And eventually, I think they're really going to run out of it, but they still have running room, and they will do everything they can to keep this tempered into the Communist Congress. Producer price fell to its lowest in 18 months. Chinese officials like to trumpet that they have avoided the inflation problems, but that's only half the story. Weaker price growth in China is largely a function of poor domestic demand. So remember, there's terrible domestic demand, weakening imports, and you still had CPI at a multi-year high. So just gives you an idea that there's a lot of this is domestic demand driven. The consumer price data shows that core CPI, which excludes food and energy costs, was just 8.8% year over year. That was down from 1.1%, but there's still some of these pressure points that remain. China may have avoided the inflation, but other economies are not are really still seeing it, and that's going to continue to be an overhang for their economy as they start to continue to whittle down. China exports, as you can see here, flatlining. When you look at exports, rose at 18%. In dollar terms, imports increased 2.3%. But the trade surplus, again, was elevated, creating that move. But another month, better than expected print for exports. Analysts have been calling the end of China's export boom for the past year, but the sector remains to outperform, myself included. But if you look at imports dropping, local demand dropping, there's more available for exports, and they're trying to offset, and you've had rolling lockdowns. So then you have this backlog that gets pushed into the market. So when you start looking at it, the part of the reason for the continued strength in exports is that companies are still working through the backlog of orders that built up during COVID-19 lockdowns. The seemingly unending export boom is also reflective of the problems with post-lockdown bounce back. Still weak levels of domestic consumption can be seen in the worse than anticipated import numbers, which is also going to relate to more going into the export market. Strong domestic production plus weak domestic demand has led to firms dumping surplus products overseas. Steel exports jumped 41.2% last month, and we still see more exports coming in time. Because we have projects hit by mortgage strikes spread across China. So again, more people are striking, more people are concerned about, where is this money going and why are they paying for something that's never going to be delivered? Again, creating more strife and problems for the CCP. China floor space started. Here you can see the lowest level since 2009. Floor space sold, lowest level going back, obviously taking out COVID, back to levels we saw in 2014, 2015. Main activity indicator for July were generally lower than expected and in contraction on a month-over-month basis. Real estate sector was once again a big disappointment as floor space started plunged to a 13-year low, while residential demand fell back to cyclical lows. Retail sales contracted to level 13% below trend despite a further rise of car sales. So even with car sales and car subsidies, it's not only are retail sales slowing, but they're well off of trend, and we don't see that adjusting. If anything, we see it continuing to move lower. Overall construction activity is down 13.6% year over year, driving home prices lower, down 1.7%. And just based on everything we've seen, everything we've talked about, we don't see that stopping. Industrial production was slightly down at 0.2% month on month, back to trend. But as we've talked about with the import issues, we do see some of this production slowing, not to the same level as we've seen with retail sales and other, because there is still that export component. But as things normalize a bit, we do expect to see exports coming down, which will pull this lower as well. Housing pre-sales and prepayments, which are critical to developers, especially when they can't get financing, is now down. Real estate developers' deposits and advance payments plus mortgages as a percent of total funding, you're getting an idea of they're not finding it anywhere. Property sales on track to fall to near 2015 lows, which we think is likely. China's residential floor space indicators plunge, and again, just more pressure to their underlying economy. India, when you look at the repurchase rate, the RBI increased rates from the expectation of 5.25% to 5.4%. As we've been saying, we thought they were going to be more proactive in trying to get in front of inflation. Industrial production, nice bounce from 10.3%, from an expectation of 10.3% to 12.3%, slightly below last month in May, but again, still elevated. Exports remaining fairly strong as imports continue to remain strong, again, supportive of where exports are, while CPI, which came in below estimates, below 7%. But when you look at wholesale prices, which were expected to be at 13.7%, coming in at 13.93%, you see that there's still that staying power to hang around that 7%, which is right where we were expecting, that 6.75% to 7%. is where we see this continuing to be a big overhang as we go into the remainder of the year as inflation continues to bite. India wholesale prices, while again nothing comes down, but the trend remains elevated. And when you look at food and you look at other pieces that may come from Europe, other components like aluminum and all of these with the droughts, we do see a food problem. We do continue to see a lot of pressure in the Indian markets, which will keep this moving in the wrong direction, and again, keeping inflation elevated in general. Emerging market Asia ex-China's manufacturing PMI is softening right in line with our expectations. We continue to see this pressure as, again, exports slow, pressure continues, and that this is indicative of what we were talking about with the developed markets, again, indicating in that slowdown that gets passed all the way through. Japan PPI expected at 8.4%, coming at 8.6%. Again, just a lot of this. Yes, inflation is slowing. The rate of change is slowing, but it's not going away, which is why, again, more about that stagflation that continues to crop up in a lot of these other areas, which is not going anywhere anytime soon. So that's what we have for you today. If you have any questions, again, you can reach us on Twitter in the comment section. I know some people have sent me emails. I owe you a response. I apologize for the delay. And again, but we, as always, thanks for watching, and we appreciate your support. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primer Vision Network.